Hello everyone, I'm Chang and I head up the Research and Advisory Services team for Marcus & Millichap. I want to thank the Kabani team for their invitation to share a few thoughts about what I see coming for the hospitality market through the remainder of this year and into 2024. As everyone in this room is well aware, the economy has a tremendous influence on the performance of hospitality real estate. Not just room demand drivers, but operationally as well. Since the onset of the pandemic in 2020, the economy has been on a bit of a roller coaster. We've had an economic shutdown, a massive wave of stimulus, a period of recovery, which was coupled with severe labor shortages, a bout of severe inflation, and a dramatic rise in interest rates. So I guess you could say the last few years have been a bit bumpy. And the top question today is whether we'll successfully achieve a soft landing. A year ago, virtually every economist believed we would be in a full-blown recession by today. But that recession hasn't come. In October last year, the blue chip economists' consensus GDP growth forecast for 2023 was just 0.2%, and they all had a recession factored in for this year. Since then, the blue chip economists have continued to revise their forecasts upward to 0.5% in January this year, then 1.1% in May, and finally to 2% growth as of the August reading. Now, a soft landing is emerging as the dominant blue chip forecast. And although the Federal Reserve hasn't admitted it, many believe the Fed's baseline scenario is a soft landing. The economic outlook has been steadily improving. Inflation has declined significantly over the last year, and the probability that the Federal Reserve is done raising rates, at least for this year, has been north of 50%. So the likelihood of a soft landing continues to rise. But before we start celebrating, I need to point out a couple things. First, no one's ever been able to successfully achieve a soft landing. And second, we have to remember that a soft landing is not a period of exceptional economic growth. The soft landing simply means bringing inflation down without forcing a recession. But that would still be a period of below trend, modest growth. And we're already seeing leading indicators suggesting we're entering the slow growth cycle. The pace of job creation a year ago was running about 400,000 jobs per month. The hiring pace has eased to about 250,000 jobs per month in early 2023, and most recently, hiring has been in the 150,000 jobs per month range. Meanwhile, the unemployment rate has begun to creep up, while inflation-adjusted core retail sales have flattened out, as have corporate profits. Economically speaking, this is pretty much what a soft landing should look like. The economy is still growing, but at a much slower pace. All things considered, this slower but relatively steady pace of economic growth should be good for the hospitality sector. At least it's much better for the sector than a recession would be. A big question, though, will be how slower economic growth will affect travel trends. Considering the positive momentum with both air travel and vehicle travel back to pre-pandemic levels, the hospitality sector may carry enough momentum to hold pace through a slow growth cycle. According to the forecasts of leading tourism and travel organizations, they expect travel in 2023 will be about on par with 2019, and travel in 2024 will be up by about 4%. So the outlook remains optimistic. But I do want to highlight that there could always be something lurking out there with the potential to disrupt the soft landing scenario. Some of the potential disruptions that I'm tracking include a risk of the Federal Reserve continuing to raise rates or keeping rates too high for too long. Another potential problem would be another banking crisis. The soft landing could also be disrupted by geopolitical issues, or maybe a weather-related catastrophe, or labor strikes, or a government shutdown. I'm sure there are other potential black swan events, but these are all real risks as we look ahead. Something can always go wrong, even in the best of times. But we can't focus too much of our attention on what-if scenarios. Now, I want to shift my focus to some of the key trends I'm seeing in the hospitality sector. First and foremost, the gains in RevPAR. This has been really interesting because all of the gains are being driven by the increasing average daily rate. The current ADR is at a record high for both full service and limited service hotels. But on the other side of the equation, occupancy rates are still below the pre-pandemic trend. A significant factor driving the reduced occupancy rates has been staffing shortages at hotels caused by the labor shortage. The accommodations sector still has 1.1 million job openings, which is close to 400,000 in excess openings relative to the number of unemployed accommodations workers. So the hospitality sector still faces a labor shortage. But the good news is that the spread is shrinking. A year ago, there were nearly 1.7 million job openings with a labor shortage of about 1.1 million. So the trend is going the right direction. The upper tier hotels are generally operating at higher occupancy levels overall than the mid-scale or economy properties. But compared to before the pandemic, these properties have had a greater reduction of occupancy than their mid-scale or economy counterparts. Looking forward, if we do achieve a soft landing and the labor shortage abates, hotel performance could gain ground as staffing levels move up to optimal levels. However, if the US falls into a recession, then demand could pull back and the sector could face a weaker operating climate. Business travel hasn't fully recovered to where it was prior to the pandemic, and leisure travel has picked up a lot of the slack. But leisure travel demand faces more risk during recession cycles. At this point, it's very difficult to offer a clear prediction of what to expect in 2024. But if we achieve the current consensus forecast of just 1% GDP growth in 2024, then the hotel market should sustain positive momentum. Now, looking briefly at the Florida markets, in general, visits to Florida in the second quarter were down by 1.2% from the same time last year. All things considered, that's a positive trend. Occupancy rates across Florida continue to outpace the national average, but they have yet to return to pre-pandemic levels. Orlando's 75% occupancy rate on a trailing 12-month average through June of 2023 is up significantly from that same date range in 2022 when the occupancy level was 68%. But Orlando is still falling short of the 78% achieved in 2019. The results in Miami, Fort Lauderdale, West Palm Beach, and Jacksonville show a similar trend. The outlier, though, is Tampa, which has had an average occupancy level of 72% over the last year, outpacing both 2019 and last year when the hotel occupancy level was 71%. But as I mentioned earlier, the big difference is in the ADR, which across Florida is up 20 to 30%. Dramatically outpacing the national average of just 17% growth. And that combination has resulted in RevPAR growth somewhere between 15 and 30% across Florida, depending on the market. So my point here is that Florida is outperforming the nation as a whole. Even though travel to Florida is down a bit, that's actually okay because staffing is effectively restraining the occupancy capacity of many hotels. The majority of the revenue gains came from rates, and the increased ADR should be durable even if the economy softens a bit. Now, looking at the hospitality transaction market, hotel sales activity is down substantively, as it is for all other commercial property types. The ongoing challenge for all commercial real estate right now is the dramatic increase of interest rates. That dramatically higher cost of capital has forced an expansion of the buyer-seller expectation gap, which in turn is making it very difficult for investors to close commercial real estate transactions. The market has begun to recalibrate, with cap rates rising modestly in the last year, but the spread between buyers and sellers remains significant. The good news, though, is that at its September meeting, the Federal Reserve held rates flat. And the consensus on Wall Street is that the Fed will hold rates flat at their next rate meeting on November 1st. Wall Street also believes there's a good likelihood that the Fed will not move rates at their December 13th meeting either. So if we are at the end of the tightening cycle and the Fed is done increasing rates, investors and lenders will have a little more breathing room and a more stable investment climate. It has been really difficult to underwrite transactions or nail down financing costs when rates are moving so quickly. So if rates hold steady, that will be a positive factor for lenders and investors alike. If the Fed gives more clarity on the rate outlook and they signal that further rate increases won't be needed, lenders could start reining in their yield spreads and their lending criteria, which in turn could contribute to a small but important reduction in interest rates. It's becoming increasingly likely that the Fed has finished its tightening cycle, but we don't know for sure. If they raise rates again in either November or December, it will sustain the uncertainty and weigh on commercial real estate transaction activity. So I remain hopeful that the Fed will hold rates flat through the rest of the year. As I wrap up, I want to reiterate that there are a lot of forces in play right now. That makes it particularly difficult to predict capital flows for the remainder of 2023 and into 2024. But overall, the hospitality sector is performing well, and the outlook remains generally positive as long as the US is able to sustain nominal growth through 2024. As I say every week on my videos, that's why you have to keep your eyes on the horizon.